Hello, everyone. Thank you for joining Hamilton Zands' market and portfolio update. I'm Corey Shirk from the Hamilton Zands Investor Relations team. We've got Kurt Hudcooper, our CEO here, and Dave Nelson, our President and Chief Investment Officer. We're here in the San Francisco office live, so we're trying something a little different. You're not staring at our talking heads on a Zoom. Before we get started, I'd like to start with a disclaimer. So we're here today to talk about our portfolio and the current apartment market. We're not offering any investments. We're not selling any securities. We're not giving tax or financial advice. If you want tax or financial advice, you should consult with a tax professional or a financial advisor. Again, we're just going to talk about what we're seeing in our portfolio in the market on the webinar today. So again, we've got Kurt, we've got Dave, you've got me, Corey Shirk from the Investor Relations team. On the webinar, we're going to start with a portfolio update. We're going to then get into what we're seeing in the overall multifamily market. We'll take a few minutes for Q&A. We had a lot of pre-webinar questions submitted, so we'll get through as many as we can, but we'll likely have to answer a lot of those on a one-off afterwards. So if we don't get to your question on the webinar today, we'll reach out to you directly, and then we'll look to get out of here in about 45 minutes. So before we get into the portfolio update, I think it would be helpful to just give an overview of what Hamilton Zands does. We do have a number of folks on the webinar who may not know much about Hamilton Zands. So we've been around since 2001, coming up on our 23rd year in existence as a private San Francisco-based multifamily sponsor. We typically focus on suburban, garden-style, 200-unit or more apartments around the country, looking for markets like DC, Nashville, Phoenix, Denver, to name a few. We take capital from investors from two sources. Most of our capital comes from 1031 exchange investors who've sold an investment property, and they're looking for a way to make that a passive investment. And then we also have a group of cash investors who invest into those same properties with just after-tax cash or self-directed IRA funds. And they are looking for the same strategy: preservation of capital, predictable income, long-term appreciation, where we're using the 1031 exchange. We look to utilize the tax benefits of the 1031 exchange long-term, where we're trading that investment over multiple investment periods on an average of a 5-year hold historically. So that's just a quick overview of what we do. We're our own largest investor. We've got skin in the game, and we're excited to talk about our portfolio and what we're seeing today. So to start, I'll hand it to Kurt to just talk a little bit about what we're experiencing in our current portfolio today.
Great. I'm going to jump right in. We can get to the commentary as we go. Current portfolio. We're 21,579 units. That's in 124 properties, 15 states, 27 different MSAs. Assets under management on a mark-to-market basis is just over $5 billion, and our equity invested is $1.7 billion. As we go into portfolio returns, since inception, we've acquired $6.8 billion in real estate, in multifamily real estate. Our returns are a 2 multiple. So if somebody invested $1 million, that's $2 million back over a 5.5-year average hold period. And our current average distribution to investors is 5%. Most importantly, right now, people are talking about loan terms and debt summary. So what we have in our portfolio right now is a lot of fixed rate debt. So there's a difference between variable rate and fixed rate debt. We like to employ fixed rate financing, and we're usually, when we're buying an asset, we're putting 10-year debt in place. And right now we have over 5.5 years remaining in our portfolio as the average loan term remaining.
So we had a submitted question about what number of loans or what percentage of our loans are variable rate in our portfolio. Do you have a sense for that?
Yeah, go ahead.
Yeah, so in our portfolio right now, we have 92 loans, and 6 of those loans are variable. So, we've always focused, especially for private capital, on putting in fixed rate financing. The largest expense line item that you're going to have in your P&L is going to be your debt service. And so for our private investors, we like to remove the risk of variable debt, know what our fixed payment is going to be. It really allows us to have a durable, a predictable income stream by fixing it in, and it also removes risk. With our institutional partners who are sophisticated, maybe what they want is more flexibility on debt, they're generally going to use variable rate financing.
I've also, in the past, when rates were lower, I've received questions from investors about us taking long-term fixed rate debt on our acquisitions. Might have a little bit lower return than a sponsor that's got variable rate, shorter term, a shorter term loan. And then also maybe someone would wonder, at a 2.15 debt service coverage ratio, are we being too conservative? Could you talk about the strategy around that longer term?
Yeah, it is conservative. We like being conservative on the private side and using fixed rate financing. I think it's proven now, especially in today's cycle where we are in the cycle, that fixed rate financing is a great place to be. I'll say that when we buy an asset, we're generally buying with a DSCR, debt service coverage ratio, of 1.25 to 1.4%. And so when you look at our existing debt coverage ratio in the portfolio at 2.15, all that means is we've been successful at increasing our net operating income. Okay, so what we're going to dive into now is NOI. We're going to start with revenues, we're going to talk about expenses, and what's going on with our existing portfolio on NOI. So starting with apartment rental income. On the revenue side, what you see here is over the last 2+ years, revenues have been going up, rents have been going up. Inflation has been a massive conversation topic over the last 2 years. Shelter and housing is 35% of CPI. And so when people have been talking about inflation being out of control, a lot of that had to do with housing costs and shelter costs. And you'll see right here, we've had rents go up significantly over this period. Next slide, please. Occupancy. So what this slide shows is, generally we're in a band. We're in 93% to 96% on the Hamilton Zands portfolio. Just a quick, what we want to point to in the box there is we bought a portfolio in the fourth quarter of 2021. That portfolio in Marin County, the NorCal portfolio at the time that we purchased it was 85% occupied. It's now stabilized at 95%. So as you get outside of the box, you see that we're trending on the portfolio wide to be about 94%. This tells me a couple of things. In a strong market where we're increasing rents, we want occupancy levels to be in the kind of low 94, high 93% range, because we're very focused on optimizing and achieving the highest rent possible. In a market that is softening, what we try to do is we try to have higher occupancy levels. Right now, we're at about 94%. I'd like to see that a little higher. I'd like us to be closer to 95. So what that tells me right now is that we are competing with new supply that's hitting the marketplace. And so our occupancy levels are a little bit lower than where we want them to be. In terms of seasonality, going back one quick, sorry. In terms of seasonality, there is a seasonality to leasing as well. And so as you head into winter, you really want higher occupancy levels because people are moving less. And so that's just another area where I'm a little concerned that we're hovering at 94. I'd like to see us a little higher there. Next slide. Okay, executed lease summary. So this is something that I monitor on a monthly basis. It's a dashboard. I'm looking at all 3 lines here. And if you look at the lowest line, the gray line, that's our rent roll. That's That's the line that we're tracking throughout the portfolio to see where we are. The gold line is new leases, and the emerald line, that's renewal rents. Just quickly as a summary, we talk internally here on a per square foot basis. If a unit was 1,000 square feet, the rent would be $1,770. That's a rent per month. But we track it on a per square foot basis. So what I'm seeing here, and is a bit concerning, is new lease rents are $1.71. They are lower than what the rent roll is at $1.73. So that's something that we need to track closely. Obviously we don't like that. What's interesting is renewal rents are at $1.77. Usually what you have in the apartment industry is you're going to have new rents being higher than renewal rents. So we're tracking that. What is good is throughout our portfolio, we have a 55% renewal conversion ratio right now. And that's a really high number when you consider suburban garden style apartment communities throughout the United States. So we're doing a good job focusing on keeping the residents in place. By keeping the residents in place, it lowers our operating expenses. And we're at a point in time right now where we're actually achieving the highest rent with renewals.
So it's also important to note the seasonality here, and this is what you can see last October, we kind of had the same decrease in effective new lease rents. Dave, I'm interested in your thoughts on the renewal conversion and what that indicates to you with what's happening with maybe migrations and people not moving as much.
Exactly right. So, excuse me, what we've seen is a lot less turnover. So people are staying in apartments longer. They're more willing to take a higher rent to stay where they're at, where they're living. One of the exit strategies they used to have, especially the product that we own, is going into single family home purchases. And even like apartments are correlated to 10-year treasury rates, so are mortgage rates. So it's very expensive to buy a home right now, especially to borrow. And we're not seeing a lot of people exit into new homes. So that's important. The second thing is that, we're still seeing positive rent growth. So if you look at the gray line here, last June we were at $1.60 and we're at $1.73, and it's not going down yet. So I think it's important to know, we are seeing rents soften. We are, to Kurt's point, seeing the gold line of effective new lease rent go down on new leases, but overall rents are still increasing. So it's still a positive time to be an owner, and it's still a positive time to be a buyer.
That's right. So you still have rent growth. It's not happening at the same pace it was before, but you still have growth. And, if we were to kind of really try to figure out why it's not growing at the same pace, you do have less household formation right now. We're seeing that, which means that there's not a decoupling. Kids are staying with their parents. Roommates are staying together. We're so obviously impacted by less migration right now. And then the big thing is just the amount of supply. We are in a situation where there's supply that's hitting the marketplace, and it's impacting occupancy levels and rent. Collection rates. Okay, so all right, what this slide tells me is, if you go to 100% collection rate, that's great, almost impossible, but 100% collection rate is what you want. Right now, we're at 94% collection rate. If you look pre-COVID, we were at 97%, and that's really where we would love to be, is at 97%. So why are we lower than that? Right now, I'd say that there's a number of reasons that we are below 97%. And one is you still have some eviction issues, and these are kind of post-COVID issues of eviction, but you're going to have eviction issues where there's a backlog in the courts and the sheriffs can't get out to evict people. And we're seeing that in Washington, we're seeing that in Oregon, we're seeing that in parts of Maryland. And then you also have fraud. And in select sub-markets of the U.S., you're really seeing some significant fraud that's happening with the resident base. We're seeing that in parts of Atlanta right now. We're seeing it in parts of Charlotte right now. And then you just also have, you have the low-end consumer is really struggling. And we don't have a lot of assets that have low-end consumer as residents. But the ones that we do, we're really monitoring bad debt and concessions and some collection issues in those assets.
So can I point out two things? All right, so just to be clear on this slide, the emerald green line is just taking our existing portfolio from January 20 to today, September 23. The gold line is showing the new acquisitions that we had. So if you look at this box, the reason it's highlighted and the reason there's a larger gap there, and Kurt alluded to this earlier, is we purchased a portfolio called the NorCal portfolio in Marin and Sonoma counties, and it's made us the largest landowner in Marin and Sonoma counties on apartments. And when we inherited that, there was some occupancy issues and some collection issues. So we've solved those, resolved those. We knew it going in, but that's the reason for that gap.
For those who don't know, Dave runs all of our transactions, and I'm curious, how have these kind of localized collection issues changed how you look at our transactions?
Yeah, so one thing is that we're using all the data that we have collected to figure out where we should be acquiring. I would say that going into COVID, we were in certain markets that were very successful markets. Coming out of COVID, some of those markets haven't shifted to the new dynamic of being able to evict and move on from existing tenants that are not paying rent. We're very cognizant of that. We're using that information to target markets that we think we can take advantage of, not take advantage of, but be profitable in today. So the markets that Kurt mentioned, we're still successful there, but we're not necessarily jumping into those markets with the bad debt issues we have and the ability to actually move out tenants that decide they don't want to pay. So it's definitely shifting our strategy currently.
Okay, back to operating expenses. We talked about the revenue side. Now we're going to operating expenses. Just as revenues have been increasing over the last couple of years, operating expenses have been increasing. It's a function of inflation. So if we were to segment out all the expenses on a P&L of an apartment community, it falls into two categories, either controllable expenses or non-controllable expenses. Non-controllable expenses are things like property taxes and insurance. And controllable expenses, we still have issues, right? Like labor continues to go up, so our labor costs go up. As somebody moves out of unit and they have to do turns, the cost, material cost, labor cost to do those turns have gone up. So our operating expenses are going up both on the controllable and the non-controllable side. And we want to show you insurance, and on the insurance, specifically how those insurance costs have gone up, impacting our operating expense increase as well.
Can I ask you a quick question for Dave? Just with our controllable expenses, it's no secret that the older assets have become more expensive to maintain. Where typically, historically, we buy an older asset, fix it up. It's a great investment opportunity for us. Now, are we looking at those differently with how expenses have increased over the last few years?
Yeah, I mean, we're really, I mean, one of the things we pay attention to is just the income to expense ratio. So markets that have lower expense ratios benefit in a market where we have rising insurance costs, rising expenses, rising utility costs, tax costs. So yeah, I mean, the thing is that we're seeing softening of rents, so our ability to grow income is declining, but it's declining slower than the expenses are growing. So the ratios are positive for newer product is basically what it comes down to. So yeah, it's influencing us. And if you look at the average age of our portfolio, it's getting newer and newer. And one of the reasons is, we're buying assets that have a bunch of green in them where the utility cost is may be mitigated, and, environments where there might be lower taxes. And Kurt's going to get into insurance costs in detail, but yeah, we're very aware of it, and it is impacting what we're acquiring.
But just to piggyback on that, I'd say expense ratios, as Dave said, are exactly what we're looking at. We're buying new things. That's one of the metrics we're going to drill into. And in Colorado, our expense ratio is going to be 38%. So expenses as a ratio to revenues, 38%. When we're buying in Texas, it's 56%. It's 58%. So it makes a huge difference. And let's get into insurance real quick.
So portfolio insurance cost, I mean, this just jumps off the page, right? Everybody can see that from 2016 to 2023, our insurance premiums have increased over 300%. It's a massive number. And if you look between 2017 and 2018, that increase was 78%. That was because of hurricanes in Texas. So that kind of started it. And then when you look at 2022 to 2023, that increase there is when bond yields started going up. So interest rates started going up. The insurers passed back the cost of insurance to the properties. So, and what I mean by that is reinsurers who would buy from the insurance companies who were providing insurance to the landlords, the reinsurers wanted higher returns because as bond yields went up, they could invest other places, get higher returns. So the reinsurers said that we are going to take half the insurance at double the cost. And so that was just a massive increase in cost that was passed through to landlords. What we're projecting for 2024 is that we're going to see another 30% increase in premiums.
So has this changed how we're underwriting acquisitions? I mean, I keep coming back to that question, some of these challenges, but, but maybe market specific or?
Yeah, there's certain markets that we're, I wouldn't say scared of, but, with insurance costs at, this is showing $799 in 23. Some markets have insurance costs at $2,600 a unit. And so how do you have enough income to offset that? And if there's a softening on the income, how are you going to make any cash flow? So, I wouldn't say we blacklisted markets, but there's markets that we're avoiding, and there's markets that we're excited about acquiring that have better insurance premium opportunities.
I guess the other question I would be curious about is this unique to Hamilton Zands? Are we like over-insured? Should we be taking a little more risk on the insurance side because of the significant increase over the last 7 years?
Yeah, no, we're not over-insured, and we should not be taking more risk. I think, for us, our insurance program can be pretty complicated. We are fully insured. And it costs a lot to have that, but I can tell you that investors can sleep at night knowing that we have full coverage. We work hard at bringing the cost down. John Gilmore, who runs our risk management platform, he goes every year, he goes to London, meets with Lloyd's of London, he goes to Bermuda. He does the domestic carriers here in the US where he meets with them. He works really hard on putting together a really complicated but comprehensive insurance program. And look, we've all seen the benefit of it. When we had a hurricane in Texas, we have earthquake insurance. It's comprehensive, it's expensive, but we know since we treat insurance carriers as partners that they're going to be there for us. And not everybody right now is being insured. There are plenty of operators out there that can't get insurance on shelter and multifamily. So we feel good about it. We think we've worked really hard on putting together a comprehensive program, and cost is going up, but we're covered.
And I think it's important for our investors who exchange with us. They may have done multiple or completed multiple 1031 exchanges with a low basis. They don't have to worry about that tax basis being at risk because of a environmental disaster or something at a property. So let's keep going.
Okay, so NOI. So we've talked about revenues, talked about expenses, and now it's NOI. Look, our expenses went up 8.1% between 22 and 23. We're now budgeting that expenses are going to go up 6.2% for 2024. But our NOI continues to go up, so revenues have also been going up. So our NOI increase was 4% between 22 and 23, and we're budgeting for an increase of 2.5% in 2024.
So I think that's good for the portfolio. A lot of detail there. Again, feel free to submit questions. We'll get to as many as we can at the end. Now we'd like to transition into more of a multifamily market update. And I think, we've listed a lot of challenges, but there are reasons to be optimistic about multifamily and what's on the horizon going into kind of end of 24, 25. So to start, Kurt, back over to you, just to talk about what everyone is asking about, which is interest rates.
Yeah, thank you. Interest rates. So interest rates impact values, right? So everyone knows right now that borrow rates have gone up. Borrow rates, as we view what's important to multifamily on borrow rates, we correlate to the 10-year treasury. As we mentioned early in one of our slides, that Hamilton Zands uses a lot of fixed rate financing. That fixed rate financing is 10-year debt. We're borrowing off of the 10-year treasury when we do that. So in terms of valuations, valuations for us comes from two places. It's what the 10-year treasury is doing, ultimately what interest rates are doing. And then the second is abundance of capital. And what we're seeing right now is we're seeing a steep increase in borrow rates and capital sitting on the sidelines. We know that there's $200 billion of fund capital that has been raised to be deployed in the United States, but is not active, is not purchasing anything right now. And so what you see on valuations is capital that's not coming to buy, as well as an increase in what your borrow cost is. So what this slide shows is, in the little box is a 0.55 was the 10-year treasury in August of 2020. It's gone all the way up. If you look to the right, it's gone all the way up, and it actually passed 5% this quarter. And when it did that, and it's not showing on this chart that crossed 5%, and that's just because we're not doing this chart on a daily basis. We're doing it on a monthly basis. But that was if you think about that, it's a significant increase in your borrow costs. The good news when you look at that chart is it's turned. So it crossed over and went to 5.1%, and now today it's at 4.15%. So that's the direction we like to see.
Well, Dave, we've had a lot of questions about capital markets. Are we able to get loans right now? Could you talk about our relationship with lenders?
Yeah, sure. So, we've got over $1 billion with Fannie and Freddie. We're in the preferred borrower channel with both of them. So, not that it gives us preferential treatment, but it gives us preferential treatment. Both of them are open for business, which didn't necessarily happen in the last recession. So, the ability to get transactions done is not diminished at all by the debt markets. I would say that, the issue is just the gap between buyers and sellers and who's motivated to sell. So, we're trying to align our equity with our business plan with the seller that's motivated to sell right now. And so that's been the difficulty, is just transaction volumes down because there's a disconnect. And to Kurt's point, there's a lot less equity in the marketplace right now. And so there's less equity, there's just less transaction volume, the opportunities are harder to find, but sometimes it's a great time to buy.
With Kurt talking about I think said $2 billion on the sideline, what are you hearing from institutions?
200 billion.
Excuse me, that's a big difference.
Yeah, so the institutional markets, and there's probably some on this webinar because we're friends, even though we're also friends and business partners. Is a lot of them are on the sidelines just because of the uncertainty in the market. And the uncertainty in the market is that chart, right? The treasury markets have moved so much that it's difficult to get a deal under contract, figure out where your borrow rate is going to be. And again, our debt payments are our largest expense. So not knowing where cap rates are going, where treasury rates are going, just puts people on the sidelines, because if they're going to make a big equity investment, they want to be certain of their investment. Whereas Hamilton Zands' approach has always been, we're always buyers. We're always looking for the best opportunity that day that we're acquiring the asset. So the institutional markets have been on the sidelines. I predicted they'd be off the sidelines at this point, but I also didn't predict this kind of growth in 10-year treasuries. So, our feeling, crystal ball, is going to be that they're going to start moving back in 2024. And one of the reasons is that we've seen this inflection point on the 10-year treasury start to drop from 5 down to 4.15. And the Fed is saying they're going to start lowering the Fed funds rate. So, we think 2024 is going to be an attractive year.
I think interest rates are definitely the number one thing investors are asking me about. The second most popular topic is supply. So let's talk a little bit about what we're seeing in the market there.
Yeah, when you think about fundamentals of apartments, it always comes down to supply versus demand. So this chart has a lot on here, but basically absorption is demand. The gold deliver units, that's supply. If you go to where we are right now, so 2023, there's more supply than there is demand. You can also see what happened during COVID when there was a huge amount of demand. It also correlated with when you saw massive rent increases starting, and then a slowdown in rent increases. Again started kind of middle of 22. So going forward, the important part of this grid, what you see here, is going forward, there's going to be less delivered units. What these projected numbers are, the source is CoStar, shows that there's going to be delivered units based upon permits pulled. Right now, one of the issues with valuations, again, lack of capital, is a lot of banks have shut down. That's not really impacting multifamily as much as it's impacting commercial and all the other food groups within real estate. It's not impacting multifamily as much because we have Fannie Mae and Freddie Mac. But why it matters about banks on this chart here is banks are the ones that lend to apartment developers. Fannie Mae, Freddie Mac don't provide development debt. So you have to go to a bank to get a loan to build an apartment building. Banks have shut down. They're doing 10% of originations of what they were doing in 21 and 2022. So what that means is even if a developer has pulled a permit and wants to build, they can't get the financing to build it. And so what we're projecting in 2025, 26, 27 is, again, we'll be in a situation of being undersupplied. Demand will come in and we're going to see faster growth in rents again.
We're in the middle of this supply being delivered right now. Like, how does that, do we change the way we operate during a time like right now?
Yeah, absolutely. What we do is we want to have higher occupancy. We want to work our rent roll where we're achieving higher occupancy. We're going to be focused on reducing expenses, whatever we can do on green initiatives to reduce expenses, whatever we can be doing to reduce utility costs. We're going to pivot from just focus on revenue growth to a focus on expense reduction. Ultimate goal, obviously, is NOI. So, try on leasing to have higher occupancy, try on expenses to lower your expenses, and ultimately have higher NOI growth.
And we've been really, I don't know if it's lucky or strategic about the supply we're dealing with now. Like Nashville, most of that supply has been in downtown, and it really hasn't affected the suburbs directly where we're invested. Certainly there's an impact market-wide when there's that much supply being delivered. But how has that changed the way you're looking at
Strategic, Corey's answer. Yeah, so we're really aware of where the construction pipelines are. It's one of the things, the criteria we look at when we're buying any asset or even evaluating is how many units are coming online, what percentage of that is supply, what's absorption been. So there's a lot of variables that go into all these acquisitions. Having new supply doesn't mean it's a market we shouldn't be in. Right. I mean, some of the new supply is tracking same things that we're tracking, like, where's new battery warehouse development going in? Where are, new semiconductor chip plants being installed? And there's a reason that they need new apartments. So it's being aware of the whole market dynamics in terms of how it correlates with apartment development. So we're not afraid of it. We're aware of it. We think that there's opportunities to have discussions with developers who may want to unload some of their new product because, to Kurt's point, they may have other assets where they have bank loans that are being pulled or developments they are trying to get done. So they might be selling the good to sort of save the bad. So we're evaluating opportunities and not afraid of new construction.
So what about we've got an example of a disposition with all of these market factors, rates, supply impacting, our current portfolio. How is that impacting our dispositions?
Our dispositions? Yeah, so I mean, we came up with a business plan, we acquired assets, and so we've executed in lots of those cases, over executed in terms of what the returns are versus what we promised. So in markets that we think we should be sellers, we're still sellers. And so again, it goes back to not being market timers. You know, we go in with realistic expectations for what we think the business plan is going to be and how we can execute on it. Then we get BOVs and figure out where the values are, and then we exit on a dispo. Some of those markets that we're exiting, you know, we feel they might be overinflated. You know, cap rates might be more compressed than they should be, or just, you know, an exchange buyer comes in who wants to overpay. So we're willing to entertain all those things. So we have no problem selling right now. We do feel like the money that we're pulling out of these assets is going into really great opportunities. And so prices are debt, right? So our ability to get really attractive cap rates is right now. If you look at where cap rates are versus where cap rates were 24 months ago, it's significant, right? So, you know, we were acquiring at 4 caps and borrowing at 3.5% debt. And now we're looking at 6+ caps, and we're borrowing, you know, with today's treasury around 5.75 to 6. So we still have positive arbitrage. We think that there's a discount to replacement cost. And what I mean by that is if the current cost to build whatever we're acquiring is, let's just say $250,000 and we're buying it for $200,000, that's a discount to the next person trying to build exactly what we have. So we think that's attractive. We think, you know, we've been long-term holders of real estate, and this is a great time to get in and hold and get cash flow at a great basis.
So can we go to the next slide where we kind of go through a recent example of a disposition?
Sure. So this is an asset we were looking to dispose of where we'd executed on our business plan, phase 1. So we went in and did some value add improvements, did some clubhouse improvements, amenity improvements, and we got BOVs, call it April of last year. And BOVs, which is the broker opinion of values, came in around 108 million. We got an off-market offer at 105 million. They walked away. We got a call for offers. Offers came around 96 million. Went to best and final, which historically has been where people put their best foot forward and give an offer that's higher than their initial offer. And in this case, just with the market conditions, you can see it was a lower price. And then people just walked away. So they decided they weren't in the market for whatever reason. Most of it was correlated to just the lack of ability to raise equity and concerned about where treasury rate movements was going. So our break-even number on this was $87 million. Well, just to be clear, if you look at April to October and what happened with the 10-year treasury, you can see how directly it relates to the purchase price or sale price in this case declining. So what we implemented was, starting in October, we started looking at, you know, what can we do to, instead of disposing of this asset, to come up with the business plan that we were trying to sell. And so what we're doing is we're implementing a new loan, taking out the existing loan, pulling more cash out than the existing loan has in place, and using that $7 million of excess to implement a value add strategy part 2. So these investors are going to benefit from the renewed business plan of getting rid of deferred maintenance, adding improvements to the interiors, and boosting cash flow. So, you know, I'm not going to take a bad situation and make it a good situation. It is for the existing investors, but I think this is a really good example of just what has happened with values.
And so you think this percentage change from the beginning of the year to where we are now is representative of multifamily for the year?
Yeah, value's down basically 15% if you look at 108 million to call it 92. I think that some of the stuff that we're acquiring is more than that. The discount is actually more significant than that. This asset in particular, it just has a lot of accretive things that you can spend money on that are still worthwhile to spend. But if you're looking at new construction, you know, I would say the values are down closer to 30% from where they built it, where they thought their exit was, versus where prices are today. And we're acquiring those also. We have no problem acquiring assets at 30% discounts. And also, you know, working with institutional sellers who may have redemption issues where they might I'll say not might, they are willing to take a discount in order to have us acquire the asset because we're got a great reputation of closing. So we're looking at assets at significant discounts to replacement cost right now. And I don't think that's going to exist. If that exists forever, then no one's going to build, which would be great for apartment fundamentals. It's going to flip back where you're going to be building and building for profit. So this is a interesting time.
Before we go to the transaction discussion here, I think it's important to note our management of loan maturities. Like if that previous example, we had a loan maturing at the end of this year, it would have been a much different story. Yeah, I don't know who this question would be best for, but.
Both. Yeah, I mean, so we've done a really good job. It's like having a lease expiration schedule of looking at what our loan maturities are and starting 3 years ahead of time and figure out, what's our business plan here? And do we need to take out the loan? Should we bring it to market? We don't want to be in a situation where we're forced to sell because we have a low maturity. That's not great for us as sellers. It's not great for our investors as investors with us. So we spend a lot of time managing that disposition portfolio and loan maturities. And so, one of the nice things is that if you look at our average loan term, it's 9.6 years, right? So we've got bandwidth to work with. We don't want to be market timers on the buy. We don't want to be market timers on the sell.
We have 5 assets that are maturing in 2024. We have a plan for all of those that's either in process, we're in the disposition process currently, or we're already refinancing. We have another handful that mature in 2025, and again we have a plan for those. We always want to be at least 2 or 3 years ahead, so it's rare for us to be kind of 1 year in advance dealing with a maturity. And so it's generally it's specific to maybe who our investor group is, if it's an institutional partner or private capital, or if it's a family office that we're dealing with. So we will adjust depending upon who the investors are. This example that Dave was just walking through on the specific asset has a maturity in 2025, and so we're dealing with it in 2023. The good news is we don't have a lot of near-term maturities for loans. So we're in a really good spot. And the ones that are near-term, we have a plan for them.
Great. So I think the last thing on our market update is just transaction volume. We talk about not being market timers, but it's not like we're going crazy when everyone else is or isn't buying. We still tend to track the market. We're just not always following what everyone else is doing. So I'm interested in key takeaways from this slide.
Yeah. We like to think of ourselves as contrarian. This slide shows that we're not as contrarian as we think, but it also just is when there's equity in the market and we're creating our equity, we can buy, and those times are usually in high transaction market times. I think the contrarian part for us is sticking to our guns when it comes to how we transact and what we're doing. Certain apartment buyers might all be going coastal at that time. When those prices get too compressed in terms of cap rates, we might be buying what they're selling. So we're contrarian in a sense, but yeah, we've been active when other groups have been active. I would say that this year is down, as you can see, and I wish we did more transactions this year. I think it's an amazing time to buy, but the markets are the debt markets are open, but the equity markets are just slow, right? So we've done great transactions here. I'm excited about them, but transaction volume's down.
Anything to add, Kurt?
No, I think Dave nailed it.
That's right. We got one more.
We do. Yeah, it's an exciting one. All right, so Fannie and Freddie. So we mentioned earlier how we're in the preferred borrower channel with both. This sort of correlates to people want to look at distress. Going back to the 90s, you can see how high delinquency was. 3.5% with Freddie and close to 7% with Fannie. COVID, you see a little, not a dip, but an increase in delinquency with Freddie. Again, I think it's really important to look. I mean, that's 1%, right? So from basically 1996 to today, it's basically been below 1% delinquency. I don't see a lot of opportunity for distress by looking at this chart. I will say you're starting to see some increases in delinquency, and really that's coming down to variable rate debt versus fixed rate debt. So, I mean, have we left money on the table by doing 10-year fixed rate debt? I mean, the answer is probably, but do we sleep at night? 100%. And the groups that are having issues right now are groups that put on variable rate debt and are having, cap calls where they bought a cap because they were required to with their variable rate debt. And that cap cost might have been $500,000 2 years ago. And now that cap cost is $2 million. So that does two things. Either investors are ponying up for that cap cost or their cash flows is being diminished. And a lot of those groups are new. There are new groups into the syndication world, or new groups trying to put deals together, and they may not have the relationships and the reputation that we have. And so I would just say that our long-term approach to real estate has really played out the last couple of years with just long-term debt. So, if you're playing the long game of real estate, it's been good being an investor with Hamilton Sands with all of our fixed rate debt. I will say, sorry, last thing on that, is there will be some distressed opportunities. I don't think it's going to be a flood anytime soon, but we're starting to hear a lot of talk of portfolios in the Bay Area that may be available, and certain one-offs in certain markets. I think one of the big things is if you're a lender with a large institution that has a bunch of real estate with you with a bunch of variable rate debt, you're going to be working with those large portfolios first to do workouts, and then the other ones will get set aside. So we'll see how it plays out.
Great. So we're already over 45 minutes. So I'm just going to take a few questions, and then we'll get out of here. First one, kind of back on that same thought pattern there, Dave. Where is HZ seeing the most exciting opportunities currently? And then the kind of sub-question, asset type, geography, new versus value add. And do you think these will change in any way going forward?
Multifamily is the answer. Yeah, so I think the exciting opportunities right now are institutions that are looking at their portfolio that have redemptions. And so they're selling something they may not want to be selling. And there's an opportunity for us to, do a loan assumption at a really positive arbitrage in relation to the cap rate. So that's great. Again, developers who are selling at a significant discount to replacement cost, I think is attractive. But it hasn't changed, our view on how we acquire real estate, which is we've got a tiering system that has 40 markets that we're tracking. It's updated every quarter with what we think the right variables are for where we should acquire and what we should be acquiring. And the second is we're tracking things like semiconductors and battery manufacturing and job growth. And so, we've got a really good bullseye approach right now. And there's a lot less buyers in the market. So there's opportunities for us to be in the right place at the right time. And we're taking phone calls right now, which 6 months ago, a year ago, it was the opposite. We're trying to get the attention that we thought we deserved, and then we were competing against groups that were, in our opinion, overbidding. So we were third and fourth place a lot in the last 24 months. Now we're third or fourth, but we're bringing award of the deal.
And I think it's important to note, we're talking about all the activity, but we've acquired 3 properties this year, so we're still sticking to our guns, staying focused on.
Yeah, we're sprinting in place, right? So, this has probably been the most difficult year just in terms of how much we've underwritten. One of the things that's happened is that institutional partners have been interested in a lot of deals that we've been looking at, and then gotten to the finish line and said, we can't make it happen. And then we chased a lot of deals where the seller has decided not to sell. They thought they were going to get 100 million, market's really 85 million. We're at 83 million, and they're just like, we're just going to wait. So there's a lot of kicking the can down the road right now. And then we've been restricted by just how much equity is out there for us to invest.
I said, and just real quick, didn't mean to scare you. We are looking for that distress. We know everyone wants to hear about distress, and even though Fannie and Freddie don't have any delinquency in their book, or it's really small, and maybe it's focused on student housing or senior living, which we don't do. We are looking for it. We're expecting it. We want to be there. We were the last big buyer of a distressed portfolio. in December of 2021, we bought through bankruptcy an entire portfolio in the Bay Area. So we are looking for opportunities that are around distress. And one of the areas that we're seeing it right now, which is really contrary, is we're seeing it in San Francisco. We're seeing it in LA. We're seeing it in New York City, where these apartment buildings in rent control markets are selling at a significant discount to replacement cost and a higher cap rate than if you bought a building in San Antonio right now. And so that it's a dynamic that's different, and we're looking for no purchases in those markets. And we're ready. We're ready for that.
All right, next question is for you, Kurt, and Dave, you can also add to it if you'd like. But what is the lending environment like for multifamily deals? I know we've kind of touched on that, but this attendee said seemingly negative. They're assuming it's negative, but are you expecting one event or series that will start banks, we're missing some words here, will start banks to be willing and are able to lend again?
Yeah, so banks have to work on their balance sheets. They need money. They need to bring money back into their balance sheets. I mentioned earlier that banks are, they're originating 10% of the amount of loans that they had originated 2 years ago. So what they're looking to do is they're looking for loan maturities when that money comes back. When a loan matures, comes back to the bank, the money comes back to the bank, it builds their balance sheet. So they need to have a position where their reserves are good. And once their reserves are good and their cash on their balance sheet is good, they can start lending again. Banks we're talking to say that they're ready. Mid 24, they're going to be ready to start doing it. They're not going to be full throttle back. They're not going to get back to 100% in 2024, but they're going to start lending again in 24 from the banks, regional banks that we're talking to.
Okay, so we're coming up on an hour, so I want to ask each of you one more question. It's kind of similar, but I think to start with Dave, I would just like to hear, we've talked a lot about some of the challenges in the market right now. What are you excited about in the next 12 to 18 months with multifamily?
Yeah, and I'll try not to repeat myself. Yeah, I mean, I think that what I'm excited about is doing more transactions, which when you're the CIO, you should be excited about doing more transactions. But I think it's going to happen. I mean, I think the National Housing Conference is in January. A lot of people are like, let's just get through this year. You know, a phrase that I hate that a lot of brokers keep saying is survive till 25, which I think is silliness. Like, this is the time to be active. And so I'm excited about institutional equity getting back in the market and, starting that little train going. I mean, we need institutional equity in, we need 1031 exchange money moving, we need the market to be dynamic. Right now, you can transact if you want to, it's just so limited, right? So, a lot of the people that we're competing with are on the golf course while we're in the office, right? So, I mean, this is the time to be active. We've been very good this year about being diligent about our acquisitions. I guess I'm excited about doing more.
And then, thanks, Dave. And Kurt, for you, I think kind of a similar question, but we have a lot of investors who call and ask, like, how's Hamilton's Ends doing? They want to know that how the company's performing. What is our outlook as a company? Yeah. Kind of the same question for you, but more maybe solid. Focused on Hamilton's Ends.
Solid, yeah. We've done a really good job. We've been proactive in managing our loan maturities. We've been through cycles before. We know what it's like when there's too much supply and not enough demand. We finished our succession planning and our retention plan at the corporate level. And we're starting on new initiatives. So our new initiatives, fund-driven and our perpetual vehicle. Hamilton's Ends is in a strong place.
So yeah, thank you for that. We're right at an hour. So with that, if we didn't get to your question, I know we didn't leave much time for that. We'll respond on a one-off basis directly for each of those questions. We'll have more info to follow on the fund vehicle that Kurt was mentioning. I think, again, to just leave folks with one thought. Look, we've thought about times like right now, this is what we're built for, long-term focus, long-term fixed rate debt, managing what we've got right now so that we're prepared to capitalize on opportunities in the future. So we really appreciate everyone joining. Please feel free to reach out to us should you have any additional questions. And we hope everyone has a wonderful holiday season. So thanks so much.
Thank you.